Josh, thank you so much for being here today. I really appreciate you guys taking time out of your busy schedule closing deals. But first, why don't you tell us a little bit about you?
Sure. Do you want to go first, Josh?
Yeah, go for it, Mark.
Okay, I am Mark Shuler, and I am a practicing architect in the state of Washington. I'm also licensed in Texas. And I also run my own private equity firm for real estate acquisitions. So I've been doing that for about 8 years. I've been practicing for about 40 years. And, just been, last 8 years, been doing a lot of deals, trying to close them before interest rate starts going up. But, it's, you do enough of them, you become a deal junkie. And I guess that's kind of where I fall right now. So anyways, that's me.
Got it. I'm Josh Welch. I'm co-founder of Three Pillars Capital. We're a Houston-based private equity firm focused primarily in multifamily assets. We look for underserved, undervalued assets that need a little bit of love, not things that are falling apart, but things that could just be managed a little bit better and modernized. So, we have a pretty big renovation component to all of our projects where we, focusing on the C-class products, what we call it, workforce housing really, and then we modernize those units and get the rents higher. And that's what generates the return for our investors. That's from an extremely top level of what we do, but yeah, that's me. That's Three Pillars.
Awesome. And the friend that recommended that I interview you guys mentioned that you were able to raise $16 million in one day. Can one of you share how did that come about and how you arrived at that level?
Well, I'll start again. That friend, he asked me the same question, and I'm going to give you the same answer. It's like, I'm not sure we know how we did it, but we managed to do this crazy raise where we kind of put it out, and we had done a lot of preparatory legwork. And I mean, we both have a very deep database of investors. We've done enough deals now that we have a lot of frequent flyers. But also, as you do a deal, I mean, your database just continues to grow as people talk to friends and family. And so, we just teed it up. We do a very detailed deal deck offering memorandum that we put out. And then, we do a lot of preparatory emails, getting people in the space to understand that the deal is coming. And at this point, we're over raising on every deal. And everybody knows that we're over raising. So they're committing, fast and early on the deals. And it just this one was kind of a record for us. I mean, at one point we were, I think, raising $1 million an hour for 8 straight hours. And it was just kind of crazy. I mean, we shut it down in 24 hours. Josh was kind of very intimately there, getting pummeled with emails and phone calls. Why don't you take point on this, Josh, and kind of relate your experience?
Sure. It didn't always used to be that way. I think a lot of it is track records, probably the biggest thing you can have in this business. Outside of a flashy deal deck or presentation, if you've performed and you've given a good return, that word will spread like wildfire. And, our investors talk and they tell their friends. And, the mantra that Mark and I follow is you're only as good as your last deal.
Yep.
If you have a deal that goes sideways or down, and, people will remember that, and it's going to impact your ability to raise money, obviously, in the future. Yeah. So that's why we were very diligent in our underwriting process, what we focus on, what we look for. And, sometimes we'll go 2 months without having a deal, and that's okay, because I'd rather have the right deal that I know is going to get me the return I need than have something that could put my investors at risk. And that relationship that we've had for so long, that takes so much time to build. So it's really, getting the track record and people knowing how you communicate. Communication's big too. You can't just say, hey, I'm raising money for a deal. I need it in a week. Here you go. I mean, you kind of you got to get people familiar with the deal, and phone calls and emails, so that when you open up the funding, hey, we're ready to go, those people have already been primed and warmed up. So,
one point I'll add to what Josh was just saying is, experience counts for a lot in this line of work. And when you've done as many deals as we have, people look at you, with, that you have credibility with people who look at you. There are a lot of folks I mentor who are just trying to get into the game, and they might be a lab tech in UW hospital or something like that. And it's just really hard for people to like wrap their head around the fact that, you know, your day job is kind of working in a lab doing statistical analysis, but now you're doing real estate as a side hustle.
Yeah.
It's really hard to get people to invest money with you. But after you've done 10, 12, 14 deals, I mean, it's a real natural kind of pitch for people to see you that way. And then also we're dealing with more and more sophisticated investors all the time. And so these are really smart people who know how to read a balance sheet and know how to read a deal deck, and they make decisions very rapidly. They're also writing bigger and bigger checks. So it used to be we'd get $25,000 checks. Now we're getting $2 and $3 million checks. And so it makes the raise go a lot more rapidly as a consequence. It also creates a sense of urgency for the folks who aren't writing those kinds of checks, because they know that this raise is going to fill very quickly. And so they got to get in really fast. So it's kind of a self-perpetuating thing. We don't try to frame it that way, but it's naturally, no matter what product type you're in, if you're doing a syndication, this is how it works.
Agree, 100%. And from what I can tell in these, 7 minutes so far, is that you guys, it seems like you guys are good partners. How did you guys meet, and how did this partnership come about?
Josh, why don't you take point?
Sure. So yeah, Mark and I have been working together for years now. We've done several deals together. And that, we met, I think it was the first deal was this 96 unit deal down in Houston. Mark was looking for assets in Houston, and that's where our company is based. And so naturally we kind of just crossed paths and kind of decided, hey, let's team up and maybe go in on this one, or if not this one, the next one, and just kept the relationship going. And I think here we are 10 deals later or whatever. I don't even know. It's been, I don't know, Mark, what's your take on how we met?
Well, so I live in the Puget Sound, and anywhere on the West Coast, but Seattle especially, the price of real estate is just insane. You're looking at legitimate 3 cap going in rates, and you can't make any money doing that. So, and also as a syndicator, I'm at an extreme disadvantage because I have to pay returns to my investors. There are lots and lots and lots of institutional investors out there that their return profile is a lot different than mine. And so I just sort of gave up on looking at stuff in the Puget Sound. And after a thorough analysis of the entire country, I decided to settle in on Houston. And I think what happened was I was doing a reconnaissance trip down there, and one of Josh's employees was a broker I knew in a former life, and he introduced us. And so, we're both engineers, we're both Michigan grads,
right?
Think a lot alike, temperamentally we're the same. So it just kind of was a natural partnership. So,
yep.
So it was basically, okay, let's try this deal together and then see how it goes. And it worked out pretty well. And you like each other's personalities, and that's how you guys continued growing. Is that a fair assessment?
Yeah, pretty good, assessment. Yeah.
So I'm curious to know, what are some of the things that you both wish you knew earlier in your career to expedite things for other people that you think that is important for them to know today?
I'm going to take point.
Yeah.
I would say the big thing. So, our company, we're a vertically integrated company. So our management is basically aligned with the asset management side. So we've got 3 pillars, which, does the buying and the selling. And then there's Green Line Management, which is our in-house management company. And I think the first thing I learned, or something I wish I would have known from day one, is how important process is to the operations, and how important the operations just are in general. I think there's a huge misconception in this industry that, if you can raise money, you can be a sponsor and go run a deal. And the more of those you can do, the better and more successful you'll be. But the reality is, if you don't know how to operate these assets day over day, year over year, they can quickly go south on you. And so a lot of people, especially in this market, have gotten bailed out by rising prices.
Yeah.
There will be a day where prices will flatline, stabilize, maybe even go down a little bit. And those who pay top dollar for something that are not running it well will not get bailed out. And so I think that's the biggest lesson that wish I could have put more emphasis on in the beginning, is how to get a better process in your operations.
Yeah, I think for me, so I come from my whole family's in commercial real estate. I have 5 family members who are commercial brokers, and one of my nephews is a quantitative analyst for a private equity firm, and it's just kind of what we do. It's a family business, and so I'm really familiar with the temperament of folks in the commercial real estate industry. Shall we say, there's a lot of male energy going on in this line of work, and I just wanted to not be that, and because I find that there's a lot of cowboy attitude and a lot of sort of unsubstantiated risk taking that a lot of people do in this line of work, and they just don't slow down and really analyze, because I don't know why. I mean, I'm analytical by nature, but either it's wild ass chutzpah, or just not knowing how to kind of underwrite a deal or whatever. But you just see people taking really crazy risks. I mean, Josh and I have seen deals where it was impossible. The numbers could not possibly work. You'd have to have 40 to 50% rent bumps to support the returns that they were quoting to their investors. And it's like, this is crazy. I don't, lenders aren't going to lend on this. Maybe they'll find some D-level lender who's going to throw some money at them. I don't get it. So as I said, I mentor a lot of people, and I really emphasize just getting a firm foundation in the industry. And there's plenty of 9-month certificate programs or masters in real estate development that you can pursue. You can also just take onesie-twosie courses, with CCIM or any of these graduate programs allow you to sit in on a course and audit it. But too many people just wing it on a hope and a prayer, and I don't know what else. But so I just counsel people, you got to get educated. I mean, you just can't waltz into this industry where there's legitimately tens of millions of dollars taking place in a transaction and think you can fake it until you make it. It just doesn't happen. So, you either get a mentor or get educated or get a master's degree. I don't know what, but you got to build on your knowledge base. And, experience is a great teacher, but some of it you just got to sit down and read about. And so that's kind of what I usually tell people. And, and that's what I did. It's not what I wish I had done. It is what I did. And I feel like I kind of propelled my career forward, by 10 years. The other thing that in this industry you have to learn how to do, you have to learn how to raise money properly. And so I joined a mastermind to help me with that and educate me. In 1 year, I probably shaved 10 years off my learning curve to figure out how to raise money effectively. And, that raise that you talked about earlier, it's, fruits of my labor from the last year. It just, if you learn how to do to Josh's point, figure out the process of raising money properly, you can, really raise a lot of money. And that can be with anything in this industry or running this private equity firm. Process is everything. It's just, you don't want to make it up all the time. You don't want to wing it. So there is, and you have a fiduciary responsibility to your investors. And if you screw up, you're done. You're never going to do another deal. So.
You both don't know how much I appreciate your response, because ever since we started this podcast almost 3 years ago, I've been saying that people are buying deals at these cap rates, and as soon as 5% vacancy happens, that's it. They're done. And I think that's potentially, coming around the corner because of the interest rates, and obviously commercial loans, you get, 5-7 year fixed rates. So what do you guys think?
Do is bake that kind of a we're in a rising interest rate environment. So
exactly.
You need to alter your underwriting to account for that. And too many people are not. They're still smoking crack or something. I don't know,
They
but
are.
they are like got these fictitious vacancy rates and this overly optimistic,
Yeah,
rent raise.
underwriting. Yeah.
It's just like you're kidding me. This is just never going to happen. What is wrong with you? And it often comes down to lack of experience.
Agree.
I mean, you can make some of these deals work. It's just the reality is you can't sacrifice your underwriting. Well, you know to be true, right? Like Mark was saying, very rarely can you get a 40 to 50% rent bump in the first year after takeover. I mean, it does happen, but very, very rare. But to go in and project that as what you're going to achieve as a base case, that's dangerous. So instead, bring down the expectations and be real about that with your investors. So maybe the deal, maybe you can comfortably do 20 to 25%.
Yeah.
And maybe your IR is going to come from a 20 to a 17. Most people probably still will be okay with that.
Yeah.
I'd rather project that and overachieve than say, hey, I'm going to get a 50% rent bump. You fall on your face, and then you got a lot of angry investors saying that you misled me. So,
Yeah.
Mm-hmm. So what kind of vacancy do you underwrite normally? Let's say in this environment today, what would you underwrite a deal? Let's say right now it's currently 95% occupied. What would you underwrite for a potential, hit in the economy?
So we kind of, our projects are a little different. I mean, since we have a heavy renovation component, we're forcing a lot of the units pretty consistently for about a year and a half. So we underwrite for about 80% economic. So call it 90% occupied, another 10% for delinquency. And then we slowly ramp that up over time. So we probably stable out about around a 90, probably 90%.
Okay.
Yeah, but in the first 2 years, we have a much higher vacancy rate to account for the renovation period. So sometimes we're as high as 35% vacancy.
Yep.
Sure.
And that's just prudent underwriting, and the reality is, I think across our renos, what is it average, Josh? Maybe 14, 15%? Or do we get higher at time?
No, about 85 is the lowest we'll go. It depends. I mean, these things are living, breathing things.
Sure.
Sometimes you get a month where a bunch of people move out. Sometimes you get months where not many people move out, but 15% is probably the lowest we would ever drop it, from a renovation standpoint.
Yeah. So, you want to under promise and over deliver. And
Absolutely.
That's one of our fail-safe metrics to make sure we're covering our butts in the underwriting is to, program in that high vacancy rate, and just, and it's just prudent business practice. And it stuns me that so many people don't get it.
Agree. And I'm so happy that you guys touched on this topic, because sometimes I feel like I'm the crazy one warning people. But it's so great to see, people like you guys that are actually raising $60 million in one day, because obviously you were successful before. And so people like you coming in and saying that it is so important. And I really appreciate that. So let's touch a little bit on architecture. Can you share a little bit of what should some operators keep in mind with regards to, let's say, commercial architecture? Let's say they're either building something from scratch or renovating a commercial building. Mark?
Well, now you're getting in my wheelhouse.
Something we might not know.
First of all, there is, I'll show you. So this is the building code. I don't know if you can see that. It's a 3-inch 3-ring binder. And so obviously there's some rules of engagement.
Yeah.
And somebody who doesn't come out of a construction or engineering background, they're devoid of the context of how we operate within the built environment. And so many people just kind of go out there and do whatever they want, and they don't understand that there's a higher authority. There's a building department, and so I have like saved more house flippers than I care to think about, because they got in over their skiddy tips, way over their ski tips, just screwing around, putting a house together without any context, without any understanding of the building code. The next thing you know, they're getting red tagged, and or they're buying product that the floor joists are in the dirt in the crawl space or something. And that happened to me one time with one of my clients, and he ended up going bankrupt.
Wow.
So, it is a big boy's game, and you've got to play by big boy rules. And too many people have too immature an attitude about it, and they get in trouble. So, what I usually tell people is, if you don't know it, you need to hire somebody who knows and understands the context. But just don't go out there and screw around, because people can die. I've had, over the course of my career, 6 people die on my project. And stuff happens. I've had tradesmen lose, fingers because they ran it across a saw blade. I mean, it's a dangerous work environment with a lot of toxicity floating around in the air. You should never have a child on a job site. I see mothers come in there with their babies, and I'm just like, what the hell are you doing? Get off my job site. So yeah, really, you need to understand that you're operating within a serious context that is very rule laden. I work in one of the most regulated industries on the planet. And
absolutely.
So if you don't understand the rules of engagement, hire somebody to guide you through it. And you'll be much better off as a consequence. And you won't piss off your local building jurisdiction, because they'd be happy to red tag you. So
that's what they're in the business to do anyways.
What's that?
That's what they're in the business to do. They can't get a clean bill of health ever.
Yeah, I got to justify their existence. So.
Well, thank you so much, both of you. I really appreciate you coming over and sharing your amazing knowledge and insights with us. Is there anything else that you think that is important for our audience to know that we haven't covered yet?
Well, don't let me be a Debbie Downer here. Look, this is a great industry. I love doing what I do for a living. It is, you're impacting people's lives. You're working in the built environment. It's creative, both from a design and engineering point of view, but from the creativity and putting the deal together is really exciting to me anyways. And I'm sort of a nerdy, heady guy, so I like that kind of thing. But, it's a fast-paced, fascinating industry that you can do for a long, long time and never get bored. And you'll learn stuff every day. You got to learn it though. You really do. And so go back to my original point. You just don't wing it. Learn how to do it correctly. And you can do this for a long time. But, parroting what Josh said earlier, you're only as good as your last deal. So if you screw up, see ya. So, so yeah, just kind of have a really balanced view of the industry. And, everybody gets excited about it when they first get into it. And it's like, I just calm down, you got a long career ahead of you, you can do it for a long time. So learn, you don't become a brain surgeon overnight. So what makes you think you can be a private equity guy overnight?
Exactly.
I would just add that, probably many of your listeners, most people don't become deal sponsors. Usually the track for most people is they educate themselves about how this business works, and they, invest with other sponsors, other people leading deals. To do this in our capacity, if you're doing a 9-to-5 or whatever. So I would say learn how to vet sponsors and understand what separates a good one from a mediocre one or a bad one. Because not all deal sponsors are the same, and obviously track record's a big part of that. So do your homework before you invest with somebody. It's probably the takeaway I'd want to give your audience.
Yeah, and talk to people, find who has invested with them in the past. How did it go? Did they have good communication, like you guys mentioned earlier, and things like that? Awesome. How can our listeners get in touch with you guys?
So for me, you can email us, 3pillarscapitalgroup.com is our website. You can check out our portfolio, kind of what we've done. And my email is joshw@3pillarscapitalgroup.com.
And you can check me out at SGRE Investments, plural.com. You can also email me at mark@sgreinvestments.com.
Thank you so much, Mark and Josh. I really appreciate your time.
Thanks for having me.